This mini lecture deals with accounting for grants. What we're talking about here are two types of non-exchange transactions that state and local governments commonly account for. In the parlance of the accounting standards, they're called government-mandated non-exchange transactions and voluntary non-exchange transactions. In government-mandated non-exchange transactions, what we're typically talking about here are expenditure-driven categorical grants in which one government is providing resources to another, or a non-governmental entity is providing resources to a government with a specific purpose attached. The government typically has to do something, spend on a particular program like special education or a health program, some type of police program, and by doing so it qualifies to receive grant reimbursement from another level of government, the state or the federal government usually. If it's a city or a town, they might be getting some aid from a county government. Or it could be a grant that's coming from a not-for-profit organization, but mostly it's coming from other levels of government. Those are distinguished from voluntary non-exchange transactions, which the recipient government enters into voluntarily, hence the name, meaning they're not required to do whatever it is they're doing in exchange for this grant aid, but they choose to. So these often take the nature of a legislative agreement or a contract with another government, and so grant aid is being provided. The recipient of the grant is going to do something in return, but unlike government mandated grants, where the recipient has to do this thing, whether they want to or not, in this case, they're choosing to do it. This will, include, to the extent that they're available, unrestricted grants and donations, meaning support aid that is provided with no strings attached, other than the expectation that the government is going to use it, in its operations and its provision of service, but it's not provided with the intention of being spent on one particular program or one particular type of service. The next couple of slides, lay out how, what the rules are for recognizing assets and liabilities. We look at both sides of the transaction here because governments may be not only recipients of grants but providers of grants as well. Certainly if you're looking at a state, states get a lot of federal aid, and they are significant providers of aid to school districts, and cities and towns and counties and so on. I'm not going to go into this slide or the next slide in detail. You can look at those at your leisure. I think it's easier to show them to you and to help you see what they look like, what the debits and credits look like for typical transactions. So I'm actually going to open up the PowerPoint now and show you some typical and very simplistic grant transactions so that you can see how the debits and credits work. This is how the vast majority of governmental grants work. A government spends on a particular program, and now it has met the eligibility requirements to receive a grant payment. In this case, it spent $100 on this program. On an accrual basis, it has $100 less in cash, and a $100 expense related to whatever it's spent on. Let's just say it's education, so it has a $100 education expense. So at that point, it's now eligible to receive the grant. So it recognizes an asset, a $100 grants receivable, and it recognizes the revenue at that point as well, a $100 grant revenue. Subsequently, after filing with the provider of the grant, let's say it's the state, and providing whatever documentation it's required to provide to show that it has in fact met the eligibility requirements, the state will then send the payment to the recipient. So the recipient now has the $100 in cash, and that eliminates the grant receivable. But you see that the effect on net position, the part that flows through the statement of activities, is when the requirements of the grant have been met. That's when you recognize the grant revenue. The subsequent payment is simply the flow of cash. It is not the recognition of the inflow of resources under accrual. Under modified accrual, it's dealt with exactly the same way. Now, let's look at the way that it gets a little bit tricky, and that is when resources are provided in advance. Let's say a government receives an education grant for $75, but it hasn't yet met the eligibility requirements, which are it needs to spend that money on education. So on an accrual basis, it has $75 in cash that it didn't have before, and it also has a new liability. We'll call it grants received in advance, because if it doesn't meet the eligibility requirements, it has to pay that money back. It has to give it back to the grantor. So there's no effect on net position. There's no recognition of revenue here because the eligibility requirements have not been met yet. And it's exactly the same under modified accrual in the governmental funds. Subsequently, the government meets the requirements of the education grant. It spends $75 on this education activity that the grant is for. So you see it has $75 less in cash. It now has a $75 education expense. The liability now is eliminated because it's met the requirement, so there's no longer any possibility that it would have to pay the money back. And this is when it recognizes the grant revenue. It's met the requirements, and now it can recognize the grant as revenue. Under modified accrual, it's dealt with exactly the same way. And I think you will find, in fact, as we go through these, that accrual and modified accrual for these types of transactions are exactly the same. The only way in which they might be different would be if there were some concern about whether the grant money was going to be available to pay for current period expenditures. And if it were not available, then the government would report the unavailable portion as a deferred inflow of resources until it actually collects the money. It just so happens that a lot of governments use very lengthy periods of availability when it comes to governmental grants. It's not unusual sometimes to see a government with a period of availability of a year, meaning if they expect to collect that grant sometime in the next year after the end of the current fiscal year, they'll treat it as revenue for this year under modified accrual. I personally think that's a little crazy, but I understand why they do it, because sometimes the state and the federal government can take a really long time to process those grant requests, and once requirements have been met, and to actually send the grant payment along to them. So I kind of understand why they do it, although I don't really think it's appropriate. I think it at least violates the spirit of the accounting standards. Now let's look at this from the perspective of the grantor rather than the grantee. You will see in looking at these journal entries that this is sort of the mirror image of the grantee. There's a kind of paralleling here between how the grantor and the grantee account for the same transaction. So this grantor has provided the cash in advance for this grant, so it has $75 less in cash, and then it recognizes an asset. We'll call it grants advanced. The reason this is considered an asset is, for the same reason that prepaid insurance or prepaid rent is an asset. Technically, if the recipient never meets the requirements, then that money is owed back to the provider of the grant. And you see, this is the opposite side of the coin from what we just looked at with the recipient, where they receive the money in advance and they recognize a liability until they've met the requirements. From the provider's perspective, from the grantor's perspective, they have an asset. It's no longer cash because they've paid out the cash, but they have this other asset that is like a receivable that says, if that recipient doesn't do what they're supposed to do, they've got to give me that $75 back. And again, it's exactly the same under modified accrual. Now, the recipient has met the grant requirements, so the asset is eliminated, and that is when the provider recognizes grant expense, when the recipient has met the requirements for the grant, and not prior to that. And it's the same under modified accrual, although, of course, they're reporting an expenditure under modified accrual rather than an expense. So that is how the transaction would work when there is some type of performance requirement, some type of eligibility requirement in order to qualify for the grant. But let's look at an example in which there is no eligibility requirement, or there was, but it has already been met. And a government receives a $50 grant that is either unrestricted or it was restricted, but they've done whatever it is they needed to do to receive the grant. However, there's another limitation on the grant, which is that it cannot be used until some period beyond the current year. So the only type of limitation on this grant is a time limitation. In that case, the government's going to recognize $50 in cash. It recognized an asset with the other the $75 it received as well. But instead of recording a liability, it's going to record a deferred inflow of resources because the inflow of resources has taken place, but it's related to a future period. You don't recognize a liability here because they don't owe this money back. There's no circumstance under which they have to pay it back. They just aren't allowed to use it until next year. So you don't recognize it as revenue in this period. You recognize it in revenue in the period that it's allowed to be used. So until that point, you're going to report this deferred inflow of resources. And then next year arrives, and immediately you can recognize the grant revenue because that's the period that it's related to, and then you eliminate the deferred inflow of resources. Now let's look at this from the provider's perspective. Again, it's parallel, so you're going to see very similar transactions, but from the opposite side. With the prior grant, the recipient recognized a liability, the provider recognized an asset. In this case, with this grant, the recipient recognized a deferred inflow of resources, so the provider is going to recognize a deferred outflow of resources. It has $50 less in cash, but now it has a deferred outflow of resources. The outflow has taken place, but it's related to a future period, so this is not the proper time to report that outflow as expense. It's the same under modified accrual. Now, the next year arrives, and you saw with the recipient that you got rid of the deferred inflow, and that's when you recognize the revenue. And for the provider, you get rid of the deferred outflow, and now you recognize the grant expense. Hopefully that clarifies this for you, makes it a little bit easier for you to understand how it works. I want to emphasize that the overwhelming majority of the time, it's like that first slide I showed you, where the government spends first, and then it becomes eligible for the grant. And then it has to apply and receive the money later. It's much rarer that they will receive the money up front, and you would then have to uh, recognize a liability if there's a performance or an eligibility requirement to be met, or a deferred inflow of resources if there are no eligibility requirements remaining, or there never were any, but there is a time limitation on the use of the resources. Otherwise, most of the time they spend. At that point, they are eligible to receive the grant, and they start the application process, but they can recognize at that point a grant receivable and grant revenue.